All right, y'all. Uh, hey, what's up? Alan Clayton, Frazzled Dad here. It is Monday, September 26th. Live schedule is going to be back on track starting at 9 p.m. Central Time. I'm going to be on here and over on TikTok. All right, hey, what do we got here today? Morgan Stanley, Chief Investment Officer, claims the stock market is full of, quote, wishful thinking. Now, I always question corporate officers, but I think she's right on this one. Hey, there's a sentiment out there that says, hey, buy the dip and DCA into this and you'll be fine. And in theory, yes, that holds up. However, this is also betting on a Fed pivot to lowering rates and or starting quantitative easing. I don't think that's going to happen. Look, the Fed put themselves in a very difficult position last year when they decided they were going to stand pat when inflation entered the building. They said inflation is transitory due to supply chain constraints. Inflation is never transitory. I mean, there may be ebbs and flows in pricing, but price increases due to inflation, those are permanent. They ignored it and did nothing. And actually continued on their path of quantitative easing, which is buying assets from banks to create liquidity in the system. And now they're doing quantitative tightening, which is selling those assets back to the banks at the same time that they're raising interest rates. And that's fine. It needs to be done. It's a little late. I mean, the Fed's been doing quantitative easing since 2008, but they've put themselves in this difficult situation. So, I mean, look at this. This is their balance sheet. Not good, folks. They've been doing quantitative easing since 2008. Really 2008. And they only did a little bit of quantitative tightening here. So, and then they've been off to the races. And that's what they've been doing, man. So they're a little late to the game. That's fine. But they got to do something. So they did. So because of the situation they put themselves in, they said, look, if we raise interest rates and implement quantitative tightening, we collapse the market and contract the economy. If we don't raise interest rates, inflation gets worse. We collapse the dollar and the economy. There's also the option of only doing quantitative tightening, which hurts the market and the economy, but inflation doesn't really get under control. And then they could raise interest rates and do quantitative easing, which is the approach that they first implemented, and it didn't work. A route that they're taking is a longer-term solution with some short-term pain. And you can see how that's working. Just look at how the dollar is doing against some of the other currencies out there. Now, the Fed said that we should be at 3 to 4% inflation by the end of next year. They also said it was difficult to see that far down the road. So I don't understand. But why do I think that we're not going to be at 3 to 4% inflation at this time next year? It's because we are not out of the woods on inflation yet. We still have to see how this year's inflation is going to affect next year's planting season. Food inflation is a real thing. We all feel it. We all see it. And it's going to be a problem well into next year. And this is not going away anytime soon. So we just need to keep our eyes on the ball and, protect ourselves from inflation as best we can. So, really that's all I got for you today. So with that, I'm going to say Frazzled Dad out. Good luck, Godspeed to y'all out there.